U.S. shale costs to soar to 95 per barrel within a decade. And I had fun writing this little bit. U.S. shale industry, a cornerstone of the global energy supply, is facing a pivotal. This kind of goes along that's the whole thing. The Dallas Fed survey caused me to write this article. This forecast signals the end of a relatively low-cost shale extraction driven by the depleting high-quality reserves. This follows also along my good interview with Trisha Curtis over there at PetroNerds, and we talked about the Permian, hit peak Permian yet, where we've not, but costs are going to rise. And Michael, I have a chart in here that is Permian Delaware current break even $55 to $64. Costs could rise 20 to 30% as tier one inventory deplete, pushing toward the 75 to 85, and regulations and flaring are really adding pressure. Take a look at the Midland area. There's other ones. So I broke it down by basin, by what is really causing some of their heartaches. And I have a feeling these are some of the reasons that Dallas Fed survey had some of those comments in there.
Well, absolutely, because I think people are seeing this, and I think really what this article is talking about is really the exhaustion of what are called kind of tier one drilling locations, which are the creme de la creme, the best locations where you can lay a well, you drill a well, you know exactly what it's going to get because you've got two wells on the other side. You're in a shale play, depletion, you figured it out, you know what your gun barrel is, all the stuff that, oil and gas engineers and geologists spend years trying to figure out. That's what a tier one location is. But then you have tier two, tier three, tier four. I mean, it's the same way in real estate. You've got your creme de la creme, you've got a little bit worse. Then you've got your stuff that's not that great, really far out. I think it's called like class A, class B, class C. You get down to tier 3, tier 4, you're a class Z sort of material. I mean, you might not even have air conditioning. You've got rats running through the facility. So I think, and yes, what is happening, and I think what's driving, I think one of the reasons why prices haven't absolutely plummeted to $40 is the fact that as we were coming into this new administration, we had already exhausted a lot of those tier ones because those are getting drilled. Everyone drills tier one regardless of what prices are, really, because because you can make the most amount of money on them. Nobody, maybe in $120 oil, you might save some of your tier one in the bank and start drilling some lower end. But that's to say that you're a company that actually has enough inventory that's split out between tier one and tier two. There's a lot of these independent companies, Stu, that they just have their locations. I mean, they don't necessarily, their acreage position sits somewhere, and they don't necessarily have the ability to say, well, we've got a little bit in this tier one area, we've got some down over here in tier two, so we can kind of jimmy around with the schedule. And I think what's interesting here is that the shift from tier one to tier two, this is according to our good friends Blackstone and Varus, they estimate that the shift alone could add $15 to $25 per barrel in terms of marginal cost by the 2030s relative to this. And we just saw, as you said, Stu, in the Dallas Fed Energy Survey, that I think the industry is echoing this. So you're right. It's a cyclical business. Prices will begin to shift back upwards. I think the question is, how low do we get on the production? How much does production drop? And you mentioned that great interview you had with PetroNerds CEO. I think it's extremely interesting to think about, and it's going to be very interesting to sort of see where these wires cross.
Oh, yeah. I'll tell you what, it's kind of entertaining out there. So it is cyclical, and my oil bull that I'm about ready to go feed in the backyard, he's getting kind of hungry. I'm still an oil bull because I think the prices are going to come back as long as we don't see World War III, and as long as we can keep Lindsey Graham's mouth shut, we may be able to survive it. So
I'm just getting a phone call here.
Yeah.
Well, hello, Michael Tanner. Oh, Goldman Sachs. You're hiring Stu as their new global oil price analyst? Well, yes, he's bullish, so we're good. All right. We'll send the paperwork. Thanks. Looks like you got yourself a new job, Stu. Oil bull. We love it.
All right. But I never gave a date.
Save yourself. All right.